Hello traders, Gary Wagner here. It is approximately 11 a.m. in Honolulu, 5 o'clock in New York. Thursday, the 19th day of April 2012, and this is the daily report for gold and silver. We have both markets quietly higher this morning, with silver showing a uptick throughout the session and gold coming off of the lows really unchanged, down $1, $1.50, currently trading up about 70. As you can see, current print 1642.03. Kitco has it at 1642.70, 43.70 bid-ask spread. And we have a low of 1631.90, high of 1654.30. High in silver 32.12 and 31.30 is the low. As I said, currently trading up about 0.5% on the day. Traders, there can be no doubt we are still looking at a market right now that is best characterized as choppy trading with pressure to the downside. Now, I did report yesterday a news story about the potential for Syria to sell gold. And a report today, and this is from HSBC, says that even if they were able to sell all of their gold reserves, that would only have a modestly bearish effect on the market. Now, according to the World Gold Council, Syria holds about 25.8 metric tons of gold in its reserves. And when you take a look at that amount, the equivalent is about 1% of the annual global gold mine output. So it's not that much. Traders, on the screen right now, what we are looking at is a weekly chart in Heikin-Ashi format. Let me move this in and kind of consolidate this for us a little bit. And what you can see here more than anything else, what I've done is I've added a simple moving average. As you can see up here, it's a 1 year or 52-week moving average. And you can see that we're literally right at that point right now. You can see how the market stayed above it and has continued to stay above it since, 2009. So to me, that is a critical indication of potential support in the market. What is important to us as we look at this marketplace right now is how it reacts as we are coming closer and closer really to the apex of this compression correction that we have identified, which really began at the top of the market, although we were expecting a standard ABC correction, which would have put us something like this, A, B, and then our C wave here. And then we had the expectations of running back into the impulse phase. It all looked good through this area, but of course, when this market came down and tested these low areas, we realized that it's quite obvious the correction isn't over. Recently, we identified the characteristics of this particular correction as really being a textbook case of what is known or labeled by R.N. Elliott as a triangle correction. On a triangle correction, what you're looking at, and this is directly from R.N. Elliott, is a series of waves. He says better call them legs, a series of 5 legs that conclude with what he called the thrust. In essence, what we are doing is getting our bottom support area. We're pegging these two lows, which would be waves or legs 1 and 3. We start, of course, from the record top. And as you can see, we fix that off of wave 2 right here. So that if this follows standard Elliott wave theory, what we will see is going to be a market that, as it gets closer to the apex, is going to, of course, build energy. And when that energy is released, that is called the thrust. And that should be a substantial move to the prevalent direction of the trend, this being a correction and the prevalent direction being up. The way we would do our count on this, of course, is we would simply look at this, all this activity as wave 1, 2, 3. That would mean that we're in 4. 4 would take us to the top of the resistance area. One more leg down, 5, and then that would conclude with a thrust. What tells us that it is a thrust? And that is the breakout really above this particular support line, resistance line at the top of the triangle. Now, we will have to see, because this count, not that it's fallen apart, but we talked about last week the fact that what R.N. Elliott says is that in most cases you get an alternating pattern of 3 waves, then 5 waves, then back to 3, and then 5, and so forth. That being said, right now we would be in a 3 count. This, obviously, we're still within our 1. I thought our 1 had ended, but the fact that we're back down to this support line, we need to see 2 things happen. The first thing is that we cannot see it violate by much this particular support area here. Now, R.N. Elliott does state in his literature and his writings that the 5th line going into the thrust will in many cases exceed or go below the bottom of this triangle by a small percentage and then move back up. But traders, from our count, we are still in count 4. And 4 meaning our intermediate count. Our major count is 3 here, and this, of course, is a corrective wave 4. And traders, finally, looking at silver this morning, Henkin Ashi chart, Japanese average, 420 minutes. And we're back to green, as you can see right in here. These small doji-like candles, in this case, where if you have a market that's been in a defined downtrend or a defined uptrend, the characteristics of the reversal, the pivot point candles, can be quite clear, but the underlying characteristics of this market has really been sideways. We had this one nice clip up, but that was all given back within a day or so. The fact that we are back to green means that we are probably going to see higher prices. However, when you look at the body size of these candles, there's really no clear defined strength within this trend as of yet. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.